In less than a week, the biggest IPO in stock market history is about to happen. Bigger than Saudi Aramco, bigger than Facebook. We're talking about a company valued at nearly $2 trillion, SpaceX. And right now, millions of everyday investors, including a lot of people over 50, are asking their financial advisors the exact same question. Can I get in on this? But here's the uncomfortable truth nobody on social media is telling you. This could be one of the most dangerous investments of your life. And by the end of this video, you'll understand exactly why and what smart investors are doing instead. Let's get into it. So, here's the setup. SpaceX, Elon Musk's rocket and satellite company, is going public. It's aiming for a valuation of around 1.75 to 1.8 trillion, trying to raise as much as $75 billion. That would make it the largest IPO the world has ever seen. Bigger than the previous record holder, Saudi Aramco, by more than double. And the hype? It's off the charts. One of the lead bankers on this deal said they expect retail investor demand never seen before. Reports suggest individual investors like you could get access to roughly 30% of the shares being offered. That sounds exciting, right? A once-in-a-lifetime chance to own a piece of Elon Musk's rocket empire? That feeling you're having right now? It has a name. And it's exactly the feeling that has wiped out retirement accounts before. Here's the thing about risk. It disappears from view exactly when it's most dangerous. When markets have been climbing for years, people stop thinking about the downside. A portfolio that felt terrifying back in 2009 feels totally normal, even boring, today. And slowly, without realizing it, we start measuring our own investments against the most aggressive thing we could have owned, instead of measuring them against our own goals. That's not investing, that's FOMO wearing a suit and tie. Now here's why this matters so much more if you're over 50. When you're 25 and you make a bad investment, you've got decades to recover. Time is on your side. But if you're 55, 60, 65, and a chunk of your retirement savings gets locked into a stock that drops 30, 40, even 50%, you may not have enough time left to earn that money back. This isn't about whether SpaceX is a good company. It clearly is a good company. This is about whether the stock, at this price, is a good investment for someone who can't afford to lose big right before retirement. Okay, let's get into the math, because this is where it gets really eye-opening. SpaceX is going public at roughly $1.75 trillion. According to its own prospectus, the company made $18.7 billion in revenue last year. Now, there's a simple tool investors use to sanity check a price tag, the price-to-sales ratio. You just divide the company's valuation by its yearly revenue. For SpaceX, that comes out to about 95 times sales. To put that in perspective, most healthy, established companies trade somewhere between 2 and 10 times sales. Even red-hot tech companies rarely get above 20 or 30, 95 times. And here's another gut check. SpaceX actually lost $4.9 billion last year, even while revenue grew 33%. So you're not just paying a sky-high price for a profitable company, you're paying a sky-high price for a company that's currently losing money. Now, to be fair, not everyone agrees this is a bad deal. SpaceX dominates the rocket industry. It's responsible for over half of all rockets launched last year and 83% of all the mass sent into orbit from Earth, almost 10 times more than its closest competitor. The technology is real. The business is real. But even the analysts who love the company are sounding the alarm on the price. Morningstar, a major independent research firm, estimates SpaceX's fair value at around $780 billion. That's less than half of the IPO price. In other words, by this estimate, you could be paying $2 for every $1 of actual value on day one. Now, this is the part that almost nobody talks about, and it's honestly the most important part of this whole video. Reports indicate that only about 3% of SpaceX's shares will be free float, meaning that's the small slice of stock that actually trades freely on the open market. Meanwhile, retail investors, everyday people like you, are expected to receive around 30% of the shares being offered. So picture this. On one side, you've got people who invested in SpaceX years ago at a tiny fraction of today's price. On the other side, you've got brand new investors, many of them retirees and near retirees, buying in for the very first time at the highest price the stock has ever had. That's not a conspiracy theory. That's literally how the IPO is built. A small slice trades freely, a large slice gets funneled to eager new buyers, and the people who got in early finally have a marquee event to cash out into. It's basically a giant, historic exit ramp for early investors. And retail investors are being lined up as the on-ramp. Maybe you're thinking, okay, but big hyped IPOs always do great long-term, right? Look at Facebook. Let's actually look at the history here, because it's eye-opening. Facebook, now Meta, dropped 38% in the 6 months after its IPO, and at one point fell over 50% from its highs. Saudi Aramco, the previous record holder for biggest IPO, lost 15% of its value in its first 6 months. And it's not just these two. A massive academic study looked at over 9,000 IPOs between 1975 and 2021 and found that about 60% of them delivered flat or negative returns 3 years later. Only about 16% more than doubled. Here's the pattern. Emotion-driven stock surges rarely last more than a few weeks. The hype gets you in at the top. Then the post-IPO hangover kicks in, and it's regular investors left holding the bag while the early money has already cashed out. You've seen this movie before, even if you've forgotten how it ends. Now, I want to be really clear about something. This video is not saying SpaceX is a bad company or never buy this stock ever. What it is saying is the price you pay matters a lot, especially when you're closer to retirement and have less time to recover from a drop. Here's something most hyped-up YouTube videos won't tell you. After most IPOs, there's something called a lockup period, typically several months, where early investors and employees are restricted from selling. When that period ends, more shares often flood the market, and prices can come under pressure all over again. So, if you're genuinely interested in SpaceX as a long-term holding, history suggests there's rarely just one chance to buy. Patient investors who wait for the hype to cool down and for the price to come back closer to actual value often get a much better entry point down the road. Know your time horizon. Don't chase hype with retirement money. Compare the price to your goals, not your neighbor's bragging rights. And if you're tempted, ask yourself, would I buy this at this price if nobody else was talking about it? Be honest. If the answer is no, that's FOMO talking, not strategy. Here's the bottom line. SpaceX is a genuinely impressive company with real technology and real dominance in its industry. Nobody's debating that. But impressive company and smart price for my retirement money are two completely different questions. At nearly 95 times sales, with major analysts estimating the fair value at half the IPO price, and with a structure that's practically engineered for early insiders to cash out into retail demand, this is exactly the kind of moment where FOMO can quietly do more damage to your retirement than almost anything else. So before you click buy on IPO day, pause, take a breath, and remember, the rocket isn't going anywhere. But your retirement savings might if you're not careful. If this video helped you see things a little more clearly, hit subscribe and turn on notifications. You won't want to miss it. Thanks for watching, and I'll see you in the next one.